I'm Tennille.
And I'm Kelsey, and we're financial advisors from 𝐷𝐼𝐼 Partners True Wealth, bringing you thought-provoking conversations around you, your money and your life on the Wealth Experience podcast. Welcome back, listeners. It's your host, Kelsey, here today. Tennille, my wonderful co-host, will not be joining us, unfortunately, as she's having a well-deserved break. So hopefully I can keep things interesting enough for you today around one of my favourite subjects. So as you can tell by the title, and you probably all know, my day job is as a financial advisor. And one of the most interesting types of clients, particularly when they just start to receive advice and start that process, are the ones that own a business or multiple businesses, and they have entities and things like trusts and companies and a bit of complexity there. And the reason why I like these types of clients is because there's oftentimes so much value that can be added from a financial advice perspective. So successful business owners and entrepreneurs are really brilliant at building a well thought out strategy for their business. And this sometimes leads to neglecting having a strategy for their personal lives, which is kind of ironic because some of the common reasons an individual will pursue their own business is for their own personal financial freedom and the lifestyles that they desire and to build a legacy for their families. But this often happens for good reason. And it can be very challenging to think about your personal financial strategy when you're kind of heads down, bums up, so to speak, working in the business, on the business and building that up because it becomes your baby. And this is why we see business owners seek financial advice to delegate that aspect of their life so they can continue to do what they do best. So I thought for today it would be good to talk through some of the personal financial mistakes business owners make, so not the ones that they make necessarily in their business, but the ones surrounding their personal life that impact their ability to actually maximise their wealth creation and the desired lifestyle that they worked so hard to create. So let's get stuck in. And first off the run is number one, using business capital as personal capital, which is really messy. So what does this look like? Well, if you're spending money from your business account that's for your personal expenses, then this is where it gets really complicated because you run the risk of not just complicating things for you and your accountant, which they probably won't be too happy about, but when it comes time to lodge your tax returns, it's possible that you've overspent. It's possible that you're managing your money in a way that's going to create problems within the business and for your own personal tax issues as well. So, if you did find yourself in a position where you have overspent and there's not enough capital in the business or to pay the taxes, then you're possibly going to be in a bit of trouble. And then you're going to have to, over a period of time, work on making that back again. So how can you manage this better? Well, first thing is work with your accountant to understand, can you pay yourself a regular salary? And actually have a business plan then that informs you how much capital you need to retain at all times in the business for emergencies, to cover your costs, and then what you might also need to reinvest into the future growth needs of your business. And then it's also really important for you to have a personal tax strategy. So if you think about these things together, it's really just about saying, have some sort of idea of how much you're going to carve off for yourself, maybe by way of salary. And then if you can top it up at the end of financial year via dividends, for instance, your accountant will help you work through that. Or you might even do that on a quarterly basis. But it's always better to make sure that you're not managing it in a messy way. So the personal and the business expenses are two separate things. Number two then, if we're talking about personal tax strategy, a big mistake is not actually having a personal tax strategy. So if you want to avoid any nasty surprises that you're possibly not prepared for, which could mean that you're going to have to scramble the money together to pay the bill on time, it's a really good idea to make a rough plan for the year ahead, as best as you can from your own personal tax planning perspective. Now, of course, being in business means that income is going to vary. So this could be something that you review each quarter perhaps, and it might look like carving off a piece of capital each month from what you pay yourself and putting that aside in a separate account for tax. That means that it's allocated away from the day-to-day spending of the business account. It's allocated away from what you're going to be taking as your salary or dividends, and it's put aside in a separate account. You know exactly how much is there for that purpose. And mentally, it's always good to see that's had some allocation and some thought put towards it. But it's definitely really good to make sure that you're doing this quarterly, yearly at least, to have some sort of idea of what you need to put aside. The next part then of tax planning, and sometimes people do fail to do this because you're thinking about the year ahead and, you know, month by month, quarter by quarter, but it's really good to also have a plan for the bigger picture when it comes to your tax planning strategy and thinking about your long-term wealth accumulation. So, for example, if you've had a good year and you don't need the money now, it could be a good idea to discuss with your accountant and financial advisor what your options are. So, for example, rather than paying yourself, say, $300,000 personally because it's sitting there in the business account and you don't need it for anything else, of course, then you'd pay the highest marginal tax rate. But if there's another option for you, such as a trust or a company, it can be really tax effective for you to still distribute the money to you and take it out of the business, but then also, paying less tax as well. So I think it's always wise to think about that from a longer term perspective. It saves tax in the short term, but also in the long term, because if you want to eventually draw on that money, is that in a vehicle that's going to be tax effective for you as well? And another then part of, and I don't want to go on too much about tax, and it's definitely the expertise of an accountant, but you also really need to have a well thought through tax plan before you sell your business. Sometimes when people are thinking about the business sale, you're not really thinking too much about the taxation part. So what might this look like then? So let's say you decide to sell the business, you lock in a price and the sale date, and then, we'll deal with the tax consequences afterwards. We just need to get that happening. Well, this can actually be of detriment. So it's always a good idea to speak about that with your accountant and advisor, because if you effectively plan for this, you could possibly make use of small business capital gains tax concessions. And this is a really, really complex area which requires a podcast all of its own. But in doing so, you can really then make a plan around what actions to take, how much to sell the business for, do you sell it in this financial year or next financial year? What's the impact of that? So certainly at point of sale, that's a really, really good trigger point to start thinking about how can I plan effectively for tax in this sale, because the less tax you pay at the point of sale, of course, the more money that you keep. So that then leads me to number 3. So another mistake is that business owners, your only retirement strategy is your business. Now, of course, if you don't have faith in your business, who else is going to? But it can be a very risky strategy in not having wealth creation and protection strategy outside of the business, because, of course, anything can happen. You might have a really good 5 years, but the next 2 years perhaps don't look so good and so forth. So it's always a good idea to, yes, you want to be able to use the sale proceeds at retirement to help fund your income needs, but certainly have other options.
Want to invest your hard-earned money but don't know where to start? Allman Partners True Wealth presents AP Direct Invest, your online self-directed investment solution. Choose from 6 low-cost exchange-traded fund portfolios, including 2 socially responsible options. To manage your own investment experience, visit allman.com.au/AP Direct Invest and start your investment journey today. AP Direct Invest, your investment solution. Any financial product advice is general advice only and may not be appropriate for you. Always read the PDS.
So, however, what we have witnessed is that many businesses, when they are having those rocky periods, or perhaps they fail altogether, because certainly that does happen as well, in having a fallback option, you're able then to have another possibility of drawing an income stream if you have something that's outside of your business. And it's just the same as invested in share markets. You do need some level of diversification. And of course, this is going to be unique to each individual, but if you take cash from the business that you don't need and you move it over to, say, superannuation or personal investments, or maybe you do this just from your own personal savings and your salary, etc., it does actually make sure that then in the hard times you're able to either sustain or it's an alternative future income stream outside of just relying on that sale. So really, really important to not make that mistake. Of course, you're going to throw everything that you can into the business and grow it, but make sure that that's not your only egg in the basket and you're thinking about other options. And the other options actually might be more beneficial in terms of, a preferred tax environment. Superannuation, pension, really, really effective. Certainly lower tax rates than personal taxes, than company tax rates. So, lots of things to think about in that space, but certainly don't have all of your thought process go into that for your personal strategy. And this leads me to number 4, and something we see all too often is that business owners don't contribute anything to their superannuation. And this really feeds into having your business, again, as your retirement strategy, and perhaps you think, well, I don't need to do that because the sale is the strategy. And it's really easy to not pay yourself super contributions as a business owner, particularly if you're not paying yourself a salary and you're just taking dividends. Because if you do take a salary, then there's a requirement to make sure that you're paying yourself that minimum superannuation guarantee amount. So, if you're starting a business, you might start off with the best intentions to do that at a later date and choose not to pay yourself superannuation to improve your current cash flow. But certainly as you get up and running, it should be something that should be reviewed and revisited. And, a little often can go a really, really long way. So don't neglect your superannuation fund. Another layer to that is, yes, contribute to your superannuation fund, but also consider the investments that you're in too. But first step is actually making sure that you do so, because you don't want to be left with nothing in your super fund and then relying solely on the business. Okay, so number 5 then is not having an idea of how much revenue and profit you need to reach to achieve your personal goals. So what I'm talking about here is the disconnect that can look something like you want more time with your family in the next few years, but you can't do that because you have to drive the business growth. But then you also have no idea of how much growth you need or income that you need to achieve what you want to achieve in the long term and have more time with your family, because you're not having to continually generate more and more income and growth. So what if you could afford to work less or just the same rather than having to grow the business, which then actually meets your personal lifestyle goals and needs? And, sometimes people intuitively know this, that they can already do that, but still continue to strive for the growth of the business. And that's fine. A lot of people are motivated and driven by that. But it's always really good to step back and ask yourself the question, why am I doing this? What am I trying to achieve? So just have some idea of how that interlinks together, what you want to achieve in your personal life versus the profit that you actually do need to generate and draw from your business to achieve this. And that all does form part of having a personal financial plan to help you make those decisions and help you project and map out what that could possibly look like. Okay, number 6 then is not necessarily having a well thought through asset protection strategy. Now, I've already previously spoke about building assets outside of the business, but an asset protection strategy is how you do this in a manner that actually protects your wealth. So some of the main ways of doing this is via structures, so companies or trusts generally is what we see, but also insurance policies and possibly some estate planning intertwined into that too. So when we're thinking about structure for asset protection, choosing the appropriate legal structure can limit your personal liability and protect your assets from the business-related risks. And this, of course, is a really complex area that also intertwines to such things like raising capital in your business, succession and taxation. So certainly you'd need to seek professional advice from your circle to make these really well-informed decisions. But from a high level, and what we have seen work really well for business owners is perhaps having separate legal entities to yourselves. So instead of being a sole trader or a partnership, having a trust or a company, obviously depending on the nature of the business too, to have an extra layer of protection that distinguishes them as two separate things. Also then, we see using the corporate trustee instead of an individual trustee, which adds another layer of protection too. Or potentially having the assets in your partner's name if they're not exposed to risk in the same way that you are via the business, if they're not part of that business. You could even then do things like having separate entities for the material business assets and then another one for the trading activities. And all of these different things have different benefits and you'd have different reasons for doing them. But it's just to be aware of and know that there is things that you can do in terms of setting up and structuring and making a plan for how you set it all out to make sure that you're protecting yourselves in the best way possible. The other one that I mentioned there then is insurance policy. So beyond the very obvious, when you start a business, you have to get professional indemnity insurance, workers' compensation cover, all of those things. There is one particular area of insurance that's important, and it's called a buy-sell agreement, which can be really useful as an asset protection strategy to help facilitate a smooth and legally binding transfer of the ownership of the business in the event of, your death, if you became disabled, or even in retirement. So it's not necessarily something that you would use if it was just you in the business, but if you do have multiple business partners, then certainly it can help for a number of reasons. And I won't go through those today because, again, that's possibly another podcast of its own. And I know that within this, there's a lot of information today, and we've only scratched the surface. And of course, we can't speak to anyone's individual situation. So I would be really interested to hear from any business owners today what areas you'd like me to delve into in more detail on a particular topic. Please reach out and let me know. And if I can't answer that question, we can certainly get some professionals, solicitors and accountants to be part of those conversations and really delve deep so you can make some really smart financial decisions when you're thinking about doing business and how that impacts your personal finances too. So as always, please make sure that you contact us on LinkedIn, leave a comment. We've got lots of different platforms of choice. We've got Facebook, we've got Instagram. So please make sure that you give us your commentary and let us know what you want to hear more of. And of course, subscribe. And I'll see you next time on the Wealth Experience podcast.
The opinions of the presenters are objectively ascertainable and are not intended to be financial product or personal advice. The opinions of the presenters are objectively ascertainable and are not intended to be financial product or personal advice.